Chris Vecchio. Mr. Vecchio, how are you tonight?
I'm doing very well, Tom. We were greeted by some nice news this morning. We have trade deals coming. Hurrah. So I'm looking forward to a market opening up higher here, right?
Oh, yeah. I think the market will probably open up. I'm guessing S&Ps are going to open up about $20, 20 handles or something. But I kind of think they're a sale. I don't even get this whole, I don't even know why anybody would buy them up on that trade deal. It seems to me to be kind of one of the worst trade deals I've ever seen. They were at 10%, they got to 15%, but they lost about 15% on the US dollar. So it's a total negative. Like the whole deal is absolutely horrible for the US. I mean, our dollars crashed and they got 5% more in tariffs, which with you take out the exemptions, it's not even a good deal. I don't even understand why the S&Ps would be up. I think it's just pure, I don't think they're going to hold. Let's put it that way. Maybe they'll hold tonight.
They hold, they don't hold. The Mets are winning. The Cubs are winning. The summertime. I mean,
we had a little crosstown classic here this weekend, Cubs and Sox, and it was fun. It was fun to watch.
I'm hearing these rumors that the Sox want to trade Luis Robert to the Mets for our third baseman. Please don't do that. No, thank you.
Oh, you don't want him. He's a dog.
No, yeah, not for us.
No, nobody wants him. He's a total dog. He had all the talent in the world, but he can't put it together. He's always hurt. You don't want him. But maybe a change of scenery will be good for him.
And it would be good for Pete Crow Armstrong too to come back to the Mets. So like
that, my friend, is not going to happen. That kid's gonna die as a Cub. He's going to finish his career as a Cub.
Worst trade. Well, Tom, so when we talk about a market that's potentially gapping open higher here, we've seen some indications with about 2 minutes and change to go until the market opens from weekend Wall Street that we should have a slightly higher open. The equivalent CFD for S&P is trading higher by about 0.34%. Same thing for the NASDAQ, about 0.4% here. The volatility has been really, really low right now. We're coming into the end of the month, and obviously this is a very big week. Josh was joking, our producer at the start of the show, that this is basically a high holiday week for me with all the acronyms coming down the pipeline: GDP, FOMC, NFP. Is this the week that volatility finally wakes up now that we have all this event risk ahead of us?
Oh, well, first of all, I'm not so sure when you say we have all this event risk that there's such a thing as all this event risk. So given how measured these moves are, and given that we tend to do the exact opposite of what everybody thinks, I'm not so sure that you're going to see any kind of a vol move at all. But let's hope so. I'll cross my fingers. I don't think an up opening today is going to, if anything, I think it's probably going to be pretty negative for volatility. So we'll see what happens. I'm kind of a seller. This is the first time I've wanted to be a seller on the opening, and I think an up 25 handles here on the opening. Maybe you get off at 64.50-ish. And it looks like the NASDAQ's going to be up almost 100 points. So you can easily have the S&Ps up 25 or 30. And I'm thinking, I don't know. I'm thinking we got a chance here. Maybe get them off at a really ridiculous number. And I'm going to put an offer in actually right now. I'm going to put an offer in above and see what happens.
Could I ask you about that, though? You say the market likes to do the opposite of what everyone else thinks it's going to do. And it feels like the predominant narrative this time around is, well, we're going to get the usual summer scaries where the market sells off in August, volatility comes back.
Yeah.
That's such a common view, though. If everyone's expecting volatility to rise and the market go down,
well, when you say everyone's expecting, I don't see that at all. There's no volume in the S&P futures. There's nobody buying any volatility at all. So I would say, here we go. We opened up 21 handles, a little bit less than I thought, actually. NASDAQ opened up 100. S&Ps opened up, let's say 23, 24-ish, right around 64.50. I thought they could get up maybe as high as 64.60, but not quite yet. Bonds down 4. Let's see, gold down 13. Anything else here? Bitcoin up 2,700, which is a big move considering pre-market it was only up 400.
Ethereum up another 5% and change.
Yeah, the euro up, which is surprising. But other than that, oh, here's your VIX. You just mentioned it. The VIX futures down 85 cents, which is almost a 4% move. So yeah, little whackage in the S&P in the VIX. Yeah, I don't like this. I think this trade deal is all just hot air and garbage, and I think it's nothing. So I don't really like this move. I think you needed a gap up opening in order to possibly get them a little bit lower. But this is the A, never sell a dull market. B, you're getting towards the end of the month, which doesn't really mean anything. But so far, if you want to lead by selling first, you have not gotten paid. Like no, there's been no payment to the short sellers.
It's funny you say don't sell a dull market here. A piece of research that I know we've covered here on the show before, and we actually talked about on Overtime last week, kind of, does the glove fit? This was just an arbitrary bucketing, but it was, if the VIX has a handle below 15, what's the best strategy? Should you do a short strangle or just simply get long the market? From 2005 until July of last year, the average daily return when the VIX was 15 or lower for the S&P 500 was 0.13%. For short strangle, it was only 0.06%. The volatility of daily returns for long stocks when the VIX was sub 15 was 0.5%, but for short strangles, it was 0.7%. So you mentioned don't short a dull market, low volume, low volatility. This historically is an environment where things just kind of grind to the upside, and it's really frustrating for short sellers.
Oh yeah, for short sellers, it's really frustrating. For everybody else, it's kind of a non-event. Like this is the tough market because you can sell stuff and you don't lose much money. You can buy stuff, you don't make or lose much money. This is the most difficult, markets, but you also take the least amount of risk right now. So I think
yes,
people have become anytime you kind of set new highs every single day. I mean, listen, we haven't had a downtick since April. So you're going on, April, May, June, July. You got four. You basically have 4 straight months since early April where you haven't had a downtick, and I think the longest down move we've had since April, maybe 2 days, 3 days at max. I wrote about it in my cherry bomb tonight because one of the things, we were just in Colorado doing a live show. And I said, if the Colorado Rockies can win 6 games in a row, there's no reason why the market can't go down 2 days in a row. I mean, that's just math. I kind of feel like we're reaching just to, try to find something that you think is, I don't know if you want to buy any more intel here, but other than that, try to find something that you think might be, a little bit cheap relative to the rest of the market. There's not that much stuff out there. So, we continue to lean a little bit short here just because I think, I don't want to say most of the good news is priced in. I just don't like the pot odds up here for getting long at, 6,450. I didn't think they would get much over 6,300, but 6,450, another couple of percent, I don't know. I mean, there's no significance in this number here. There's no significance in any, specific.
In any number.
Yeah, there's no significance in any number. It's just a point in, in the pot odds game right now. I mean, this has been just, an incredibly strong market, and it's doing it without the bonds. It's doing it without, the fact that the US dollar is so heavy is one of the reasons that the market has done well, because it's cheap to buy US stocks with any other currency. So that has not hurt it. That has not hurt the market at all. The leaders are still the leaders, but I think when you start to see a couple of these stocks start to roll over, you haven't seen it yet, but if you start to see a couple of NASDAQ stocks, I thought last week we had started to see the first kind of crack with a few of the NASDAQ stocks getting kind of soft midweek, like on Wednesday. And I thought that might, be a turning point, but it wasn't.
That's not Tesla. This is Tesla. Last week, obviously, we had a very important set of earnings with Tesla, IBM, Google coming out. This week, though, it feels like it's all the more important. I'm personally really excited for Wednesday. So Wednesday morning at 8:30, we're going to get GDP. We're going to go to the afternoon, we're going to get FOMC. Wednesday afternoon, we have Microsoft and Meta earnings. Thursday, we're going to have Apple, Amazon. Friday, we have non-farm payrolls. This has to be okay, I know I said there's a lot of event risk coming. Can you acknowledge with the earnings calendar, this is an important week?
Okay, you can say that if you want to, but let's go back and just look at last week for a second. Google, after earnings, was up $2. And after earnings, actually that night was down, but then it rallied overnight and then it's up $2. Or the stock was 191 and change. It's 193 and change after a huge up move on Friday. So Google was basically unchanged. And Google was probably the weakest of all the stocks going into earnings. Tesla was down, whatever, $20. I know it rallied on Friday, but it was down $20 on earnings. IBM was down $16 or $17 on earnings. I mean, this was not a week, the market went higher, but you did not get any kind of accommodation from IBM. You got no accommodation from Tesla, and Google was basically unchanged, and the market didn't care. So it is very difficult to sit here for me to say, oh man, it really matters what's going to happen in Apple and Meta. I as somebody who wants to play the downside, not really in Apple, but more so in Meta, I kind of think good news in Apple might be bad news for the market, and good news in Meta might be bad news for the market, because bad news is good news now. So sometimes when you get in a bull market, bad news is good news and good news is good news. I want to see, we already know that bad news is good news. I want to see if good news is good news or good news is bad news. And we have not seen that yet. We have
Can I dig into that?
Really good news.
I'm keenly interested in actually taking that conversation a step further, because I've been on the mindset for the past few weeks that good news is good news. Any data from the second quarter that shows we survived the tariff scare is ultimately fine. The Fed doesn't need to cut. The economy is in good shape. Stock market can keep rallying. But you now saying bad news is good news. What tips that scale for you?
Just the tape action. You get a stock like, IBM, you get a stock like Tesla that completely miss, and both of those indexes, both those futures markets, up as soon as the number comes out, both those futures markets go higher. And so you start to wonder, you're like, well, if the Nasdaq's not watching Tesla and the S&Ps and the Dow are not watching IBM, what are they watching? And you're not getting any kind of a rally in the bonds or anything. I think what's happening is you are continuing to get a lot of people that are just bottom fishing on they're being able to take advantage of a super low dollar. So rather than us sitting here saying, oh, you know what, this is just some misread of the tariffs or any of that kind of stuff. I don't think so. I think this is not a statement on that at all. This is just a fact that people that buy equities and people that buy whatever asset it is, if you think you're buying them with relatively cheap dollars, it's an interesting play. That's it. You think you're getting a discount, whether it's 10%, 15%, 5%, whatever it is, it's a discount. Mm-hmm. And people like to buy things at a discount. And I really think that's what we're looking at way more than anything else.
Do you have any strong opinions on, you've had a few days to digest it now. We had the weekend here, the market's opening back up. Before we move away from stocks, this new meme stock surge, if it's been names like Open or IREN or Kohl's, a few of these companies have really exploded to the upside. Are any of your spidey senses going off about something, an echo of January 2021, or is this not rising to that occasion yet?
No, this is not rising to that occasion. This is just, because I'll tell you why. Because there's there's heavy volume, but I don't think that, these stocks are really uninteresting. I mean, if you're going to start telling me that Kohl's and Open are going to, we're talking about rinky-dink, crappy little companies with, a few $1 billion of market cap. I think you have to be really careful here to read too much into this. This is just, there has always been a tremendous demand for speculation, and there always will be a tremendous demand for anything speculative. And in a period of time when literally there is no sports, to bet on, there is a lot of people out there that with free commissions and penny-wide markets are willing to take a shot on something they know nothing about, like a $2 stock like Open, rather than, laying whatever crappy odds they're going to get on DraftKings or on some kind of binary event marketplace where the odds are terrible, as opposed to going into something that's a penny wide with no commissions. And I really believe that that's all this is. Can you get 1 billion shares out of that? Well, in the case of a $2 stock, maybe. In the case of Kohl's or something like that, you need to start some rumors and that kind of thing. Mm-hmm. It's a very small percentage of market cap and trading volume, especially at Tasty. It was a really small percentage of our business, tiny. I think at some platforms, maybe like Robinhood and stuff like that, there's a lot more younger people that are they get sucked into this type of thing. It's like a meme coin type thing, but not a Tasty, not a big deal. And no, I'm not buying into it at all. I think there's just, we always lose sight of the fact how much interest there is in speculation. The idea of risk a little to make a lot is never going to go away, especially with young people. And you know what? You got to get, I like it. I like the idea that people try it with stocks because it gets them involved. And the technology is so simple and it's easy to understand. It's not rocket science, but I don't think it means anything. If anything, is it a red flag? Maybe a tiny little red flag, but I don't think it's nearly the red flag, that Meta trading at $715 is.
Before we go off of stocks, one more thing, I suppose, here, or two more. That comment you made about no sports being on really piqued my interest because it feels like we've had a lot of green Julys recently. And maybe this whole function of there being a green July for the past decade plus, it does coincide with the rise of sports gambling with like FanDuel and DraftKings.
Well, Chris, something that nobody ever talks about, but I have mentioned it before. You never see a meme stock explosion during football season. When there's fantasy football and when football season is on, which most people bet on, you never see anything to do with meme stocks. Nobody cares. Okay, meme stocks are like the king of March, April, May, after football season and summertime when there's nothing else to gamble or bet on and things like that. So yeah, don't read too deep into this. And I would much rather see young people, if they're going to speculate things that are way more interesting than meme coins or meme stock, or meme coins or football betting.
Sure.
I'd much rather see them speculate on, a dumb stock like Open or Kohl's or anything else. I don't care what, what you want to buy, just because I'd like to see them get involved in the markets and know that it's there.
We did talk about the European trade deal. The U.S. and China came to a bit of a reprieve. They announced that there's going to be a new 3-month extension, 90-day extension here on the clock. So that was set to expire on August 12th when these negotiators meet in Sweden tomorrow. Apparently, according to the South China Morning Press, they will announce this 90-day kick the can down the road. Tom, I've been talking with people on Twitter about this today, people who tune into the show. I'm curious, do you think this is a boy who cried wolf moment where Trump is proving it's another taco trade? Is the administration pushing out a new reason to ramp the market in November before the end of the year? Are we just going to turn away from tariffs now if we've now seen the fact that, okay, every 90 days we're just going to kick the can, don't even pay attention to it?
I've been saying this since April. The whole the concept of tariffs is the worst trade policy in American history, in the history of American trade. And so this was kind of the dumbest plan any president's ever put forward. And it's obvious based on, what happened to the dollar and initially how the market reacted and all that stuff. Everybody saw through it because they realized that A, it was unenforceable, undoable, and B, Trump would look for a way out, of which he's, by delays and by making a couple of really crappy deals along the way and conceding, he's basically, found a way to escape without, by saving face a little bit, and claiming victory, even though it's a complete loss everywhere. So I think that, for him or just in general, I do think that the way that you get to lower interest rates and the way that you get the Fed to cooperate is you basically drop all the tariff nonsense, which is putting all the pressure on inflation and everything else. So I think what they've been looking for, is kind of an easy way out. And they're kind of through distractions, through bad deals, whatever, they're effectively doing that right now. The challenge for this administration is going to be, how do you save the value of the U.S. dollar, which clearly they've butchered, and save face at the same time, and work lower interest rates into a better story, because that's the story that's ultimately going to kill you if you can't get rates to go lower. So, those are their challenges. It's probably, the market actually doesn't care, because for now there's plenty of cash out there. There's plenty of buying, and the market doesn't have to really pay attention to that, as long as, it's like it's almost getting too big to fail in the short term, and that's where we're at.
Let's move over to the rates and bonds markets here, as you just briefly brushed up against them. This week, there's a 2.6% chance of a Fed rate cut. If we go out to September, those odds for a cut are obviously higher, but sitting around 62.4, we'll call it 64% when you add up the 50 basis point odds as well. What could the Fed tell us this week that would dislodge this market? Or do you think Fed Chair Powell in the very tight security has? Yeah,
they're not going to say anything that's. He's not going to say anything that's going to dislodge the market. If anything, I still, our biggest longs are bonds and notes right now, because I like the upside of bonds and notes. I just don't think there's that much downside other than, a default risk. But I don't understand why the 10-year notes trading just over 10 and the 30-year bonds trading just over 13. So they seem way too low for me. So there must be a lot more risk out there than I see. But I feel both of those, I like bonds and notes here way better than stocks. I just think that the upside in bonds on a percentage basis for me has to be so much better than stocks. I just don't understand why nobody else sees that. So that's what scares me, because I'm looking at something that nobody else is seeing, or somebody else is seeing, but they're not trading it. So I don't know. I'm going to stay long those two underlyings, and we'll see what happens. I don't think there's a lot of other plays out there.
Well, I mean, the risk to reward, the longer term charts, right? You throw up a monthly SPY chart, you're going to see a chart that's climbing to the very top right. TLT here.
Yeah.
These are the lows that we've seen since 2006.
Yeah. No. I understand. I like these here. I'm long TLT. I'm long ZB. I'm long ZN. I'm a contrarian. I like all these markets. Those are, I think you've got to be long them, but the trend players will tell you you're out of your freaking mind.
Yeah. Well, the trend, we would. Yeah.
Yeah. The trend players will say, what are you talking about here? You got to be long NASDAQ, S&Ps, whatever. I think the S&Ps are getting to a level here at 6,450, and it doesn't mean anything. 6,450, 6,500, 6,550, 6,600. It doesn't. There's no number up here. It's uncharted territory. But at some point, you get this potential, risk reward thing, which I think we've been there for a while. I think we're really extended right now, just meaning that, feels like you take a lot of risk buying them here.
You could be. The PE ratio for the market at these levels is lower than it was at the end of September last year. So if you like the market at the end of September, it's cheaper now, technically.
There you go. Well, you can, if that's the game you want to play. I don't usually play that game, but because that's not the game I want to play. Well. That game's not a fun game for me. It doesn't really work too well over time. Those are the kind of, when you play the PE ratio game, you can play, you're playing the long haul game, and I have no problem with the long haul game. I just think, there's a difference between passive investors and traders, and traders are kind of a different animal. So I'm gonna, my time horizon is Friday. Tomorrow's Monday. My world ends on Friday, and then the following week, we start a new Monday to Friday. So I don't have the same, I don't have time to wait for PE ratios to turn around and that kind of stuff.
It's so interesting that you say that. I read a piece of research this week, and I think Cliff Asness shared it on Twitter of AQR.
I'm not sure.
He's a hedge fund manager based here out of Connecticut. He writes for the Wall Street Journal time and again, but he was talking about how passive investing has actually had the impact of increasing latent PE ratios over time, because you have indiscriminate buyers who are willing to buy shares in the market at any price. So valuation doesn't really matter when you have automated investing happening. Interesting perspective.
But automated investing has been around now for, there's no, essentially since the origin of, or the genesis of 401ks, there's been the concept of automated investing. I mean, nobody really, in the old days, it was how much money you're dumping into this mutual fund. In the new days, it's just, take my money out of take my salary, put it in my 401k, and then auto buy it. But there's no, people just don't move money around the same way. It's all advisory.
Let's go here into gold and silver for a little bit.
Sure.
Metals have come off the board the last few days. Silver, gold are gap opening lower here today. There are decent pullbacks on the board after a big setback. What do you think about these levels? Because vol has come in quite a lot off the highs. In silver. I'm short premium in gold and silver. I don't love either of them because the vols, like you said, the vols come in dramatically. Used to be crazy high. It was crazy expensive. Now it's gotten very cheap. So being short premium in gold and silver right now is a very marginal play. There's just a tiny bit of edge. I don't have any directional bets on here. I mean, if anything, I'd probably be long a little gold relative to silver. I think silver is expensive relative to gold. I mean, that gold-silver ratio has gone, moved over 20 handles, which is a $20,000 move. It's massive. So if I was to bet, I'd say silver is a little rich relative to gold. I don't like either of them long-term here. I think they're both expensive. I think they both, all the chatter about repricing gold and the lower U.S. dollar, anytime a dollar goes sharply lower, gold goes, it just remains crazy strong. And then you throw in the repricing argument and everything else. I don't love either of those two assets here. I think they're expensive. I think Bitcoin's expensive here. I think crude oil's expensive here at 65. I think the stock market's expensive. The only things out there that I think are cheap are bonds, notes, any kind of debt instrument. I think natural gas has gotten down. It's in the 3 handle right now. I think that's kind of cheap. And I think the US dollar has gotten to the point where it is, you could argue that on a relative basis, it's historically cheap. So you've got a couple of different instruments out there that I think are cheap. But if I was to say to you, Chris, name 10 liquid stocks that you think are cheap, I bet you couldn't. I mean, Google is the only one trading below its 5-year PE. Other than that,
okay. Well, Google,
seriously, I can't.
Google's also rallied. Google's also rallied from 155 to 195 or 193. It's up 40 handles, since April. And when you think about other stocks out there, I mean, you can give me a stock like Intel, which is a $20 stock, or you can find, a crappy stock like Chipotle, but find me some stocks, IBM after its sell-off of 30 handles, but really what's cheap out there? You're hard pressed to find a place to dump money into in the equity world right now that's cheap.
Yeah, I'm just running a quick scan here. I'm not.
Yeah, there's some Chinese stocks that I think are a little cheap, but for the most part, you go through, you scan your watch list among the most liquid stocks, you're going to have a super hard time, of finding stocks that you think, it's a list of, if I said to find 10 stocks, you'd be hard pressed. Anytime in history when you get somewhere where you say, I'm hard pressed to find 10 stocks that I think are cheap, but you could find 100 stocks that you think are expensive, I think that's the time when you got to I don't know, just think about it for a second.
I'm having these conflicting polls myself because I look at CTAs, they're in the 90th percentile for U.S. equity longs over the recorded history of the entire data series. But on the other end, Hedge funds, according to the CFTC COT report, the most short stocks they've been all year long. AAI bulls down 4 weeks in a row. Net asset, managers reviewed 2 months, 2-month low here. But the S&P just had 5 days in a row with new all-time highs. I mean, it feels like a lot of us are all talking the same talk, which is like this thing feels expensive. It feels like it's too high, too far, too fast. And so we've all placed that bet in some form or fashion. And yet
but if you go around, I mean, I talk to a lot of customers and I participate pretty actively. And I think, Tony and I both have a lot of interactions, and the street is not short. Like when you go and you just, I've had plenty of times throughout my career where like every trader I've talked to is just, they're just balls out short. It's not the case right now. Everybody is like, oh, I'm flat. Oh, I've got a few short deltas, or I got few long deltas. Oh, I'm relatively flat. I hear nobody talking about, any kind of downside risk. I think we got grossly oversold in April when they scared the children. And, and so this rally back has been incredible. And we're in the process of getting grossly overbought. I think the biggest change that we've seen in the 2020s, since from 2020 all the way through now to 2025, so over the last 5 years, the biggest change we've seen in the markets is that we no longer, we're not as cyclical. It feels like everything's not as cyclical as it used to be. It feels like we go to these crazy price extremes. Like we either get way too overbought or we get way too oversold. Like there's no in between anymore, and I think that a lot of us that are used to more cyclicality, we're not seeing it. So, maybe that's something to take into consideration, as we kind of go forward.
I know it's akin to more of a boom bust cycle, but it really underscores the need when there's blood in the street, be greedy. And when everyone's out there popping champagne, that's the time to reel it in and start shuttering the hatches. I'm playing this. I'm playing this out of both sides of my mouth, Tom. I am running up short-dated Nasdaq call spreads, and I am long S&P 500 puts at the end of August. And I'm just putting coins back into the machine basically week after week. Let's look for a market that's 2% higher from here. Let's buy 7 DTE calls. It's going to break at some point, but got to keep running it up until it stops.
I mean, easier said than done.
I've been very nervous. I thought,
as somebody that's been doing this for an awfully long time, way easier said than done. It's easier to be short and be wrong than try to be long and squeeze the last few shekels out. But again, like I said, as somebody who's been doing this for a really long time, that's super challenging. I have been waiting for a decent gap up. We only had one gap to the upside last week, if you remember. I think it was Tuesday morning, but I'm not 100% sure if it was Tuesday or Wednesday. But we had one gap opening. Which day was it on there? 21st. I think it was Tuesday. Looking at that chart.
Yeah, right there.
So, okay.
Yeah, Tuesday.
So Tuesday morning, I think we gap opened about 35 handles or so, and we ended up down 30 handles or 35 handles by the end of the day. And that was the only time we had a gap up, like a serious gap up all week. And again, with the expected move for the week of only like $65 or $70, it's a tiny move. So that was we had the week move in one day on a gap up opening. I'm thinking tomorrow, if we can get a decent gap up opening on this trade stuff, which is in my opinion, complete garbage. I think we got something. I don't know. You got an interesting shot. I don't think they're going to open down and stay down. Just the way this market's trading is too slow. I think if they open up, they could go down. But if they open down, they're going to go higher. I know that sounds like old cliche stuff, but that's the way I've been trading lately. If they open lower, I'm kind of expecting a rally. If they open higher, I'm kind of expecting them to sell off.
All right, take me home, country road. 1 minute left. What are your final thoughts as we embark upon this trading week?
Well, we appreciate everybody coming out on a Sunday night. I mean, I know it's summertime, so not that much crazy stuff happening, but NASDAQ is up 87 right now. S&P's up 19. Dow's up 140 and the Russell's up 12. Just take a look. Bonds down 2. That's nothing. Bitcoin's the big mover, up 3,200, but gold down 4. Not much there. Crude oil unchanged. VIX only down 51 cents now. It was down 80 on the opening, so down 3%. I think I just summed it up. Higher opening looks like a higher opening based on all this trade news. And I think it's a sale. I think we closed about 5 handles overvalued on Friday. So on Friday afternoon, they closed the cash and then they rallied the S&Ps about 5 handles after the close. Whenever we close with either too much premium or too little premium, like whenever we close underwater, we usually rally. Whenever we close with too much premium, it's usually a case of, the shorts getting squeezed on the close and they cover. So we closed with too much juice on Friday. So I think they're rich to start with. And then if you throw another 20 handles on top of that, I think they're a little expensive here, and I like the pot odds to the downside. So I think this week you got, like you said, a lot of numbers, a lot of news. It's going to be relatively thin markets. I think you stand to make more money trading from the short side than the long side, but it's only like a $68 or $70 expected move. Oh no, you take it back. Let me check that. I don't want to say because that was last week. And I want to make sure that I don't give you the wrong number. Hold on. Let's do this as the closing.
End of the week, S&P 85 points, plus or minus.
Yeah, right. Because I forgot they have the non-farm payrolls and everything else. So 85 points.
Right.
Yep.
Well, we got a fun week of programming starting tomorrow morning, bright and early, 1:30 a.m. Central Time, 2:30 Eastern. Trade Live with IG. And then, of course, Tom, you're back with Tony tomorrow morning in Veneta for Daily Dose and getting the trading week started.
7 a.m.
Excellent. See you later, boss. Thanks, everyone.
Ciao for now.